Hello, beautiful people, and welcome to another brand new episode of the ITU Forex class. In this week's episode of the class, we're actually going to be talking about managing drawdowns effectively, okay? And the reason this is one of the classes that you should really pay attention to is simply because this this part of the tutorials, this part of the class discusses a thing that traders try to run away from, in as much as that particular thing is something that is inevitable in trading. Okay, and what thing am I talking about? The thing I'm talking about is drawdown, or in simple terms, it just means losses in trading. Okay, and if you've been trading for any period of time, I'm pretty sure if it wasn't the case that you got involved in trading by uh, being introduced to trading by someone who already knows much about it, okay, and so he sat you down, broke down everything to you, and explained to you how losses, just like wins, are part and parcel of trading, then you probably would have gotten into trading with having the mindset that losses you are something you can actually escape by learning more about the market or learning more about how the market behaves, because that's usually where most of us got our start from. Okay, that's usually where most of us got our start from. The truth is, most of us, when we first got involved in trading, we learnt about, what a pip is, what is the market, what is buying and selling, all of those things, okay? And then eventually we reached the point in our trading career where we learnt about trading strategies, about risk management, and all of that. And so when we were at that point of learning what trading strategies were and how they affect the way you use them in the market, we would transition from learning about the strategy to actually practicing the strategy in the markets, whether it be on a live account, or which is one of the mistakes that most of us make, or a demo account. Okay, if you're fortunate enough to be told to try it on a demo account before you transition to live trading. But the problem is, let's assume you learned a trading strategy, and the person who taught you that trading strategy explained to you that the strategy is actually profitable. You just need to follow the rules, and when XYZ happen, you just do ABC and whatever the case might be. But then let's say immediately after learning the strategy, you went to deploy it into the market, only to find that, okay, the first trade you took with the strategy was a losing trade, which is just maybe you might be like, okay, losses are part and parcel of trading, somebody has told me that, so no problem. But then you take the second trade and it also turns out to be a losing trade. Now, even if you might not want to tell it, say it out loud, the truth of the matter is, at this point you'd start to kind of have doubts about the trading strategy, because if it's really profitable, then why are you losing trades? Okay, and I'm telling you this because most of us have passed through this particular thought train. Okay, because we'd learn a trading strategy, would assume that, or let's even say beginner's luck, just got the better of you. So you learned a trading strategy, and when you went to apply it in the live market, you got beginner's luck. And so the first few trades you took with the trading strategy were all winning trades. And now you think trading is very easy. And so, you when your mentor is telling you to risk just 1% of your trading account's capital on each trade you take, you now start feeling like, the mentor doesn't know what you've got. Maybe he taught you a simple trading strategy with a market structure or whatever, and you learned something, about the SMC or whatever on YouTube. And now you feel, you've taken a couple of winning trades with the method you've learned. And so the mentor is telling you to risk 1% because he doesn't know how to trade. So instead of, following the advice, you now decide you're going to risk 5% or 50% of your account on a single trade, because you just feel your trading strategy is that good. Okay. And so you do it and you end up blowing your account. And then you realize that trading is not as easy as most of those gurus would make you believe. And so you start at this point, you would start trying to run away from taking losing trades, because usually what happens is, you would try this trading strategy and you'd get a couple of winning trades with it, you get a couple of losing trades, but you now start feeling, okay, this trading strategy is losing because maybe it's probably not the best trading strategy out there. And so you start trying to find the best trading strategy, which most professionals will tell you is like searching for the holy grail, or you don't go searching for the best trading strategy, but you go searching for components which will help you to make your own version of the best trading strategy, which is not never going to lose. And so this is just going to put you on a hamster wheel of trying to, create trading strategies or find trading strategies that are going to win 100%. Excuse me, 100% of the time, and that never happens. That's just a losing battle. I want you to have it at the back of your mind that however good your trading strategy is, you're not going to have winning trades 100% of the time, regardless of how good your strategy is. In fact, just so that you have peace of mind in the future when you're trading, live, I want you to have it at the back of your mind, okay, that whichever method of trading you choose to use, just assume that it's going to win 50% of the time and it's going to lose 50% of the time. When you come into trading with this mindset, it will make a whole lot of things a lot easier for you. Because the moment you accept that losses are part of trading, okay, that's going to trick your mind into now believing that, okay, since losses are part of trading, whenever I place a trade, since losses are part and parcel of trading, I don't know whether that trade is going to be a winning trade or a losing trade. And so that will make risk management important to you. And let me break it down for you here. You can trade with any trading strategy, okay? If you don't have good risk management, no matter how many winning trades that trading strategy is able to call, you're going to find it difficult to be profitable. And so if you have your risk management in check, the trading strategy you choose to use is just, it's not as important. Have risk management in check, have the right mindset so that even if you have 10 losing trades in a row, you still follow that trading strategy you're using. Or if you have 10 winning trades in a row, you're not going to start breaking the rules of your trading strategy, feeling that you're above the market now and above the rules of your trading plan. That's all it all boils down to, okay? So with that long-winded introduction out of the way, now we're going to be talking about drawdowns, because the reason why I took long to explain that losses are part and parcel of trading is because drawdown is actually an extension of what losses are in your trading. So what exactly is drawdown? Okay? Drawdown is the percentage drop from your account's peak to its lowest point. So to help you understand what I'm talking about, assuming you have a $100,000 trading account, and so the account starts at zero because you haven't traded the account and you haven't made any money with it, or whatever the case might be. Okay? And so the account starts at zero, and let me quickly do this. Yep. And so the account starts at $100,000. You haven't made any profits with it. But let's say you went and you took a trade on the account. You're risking 1% of the account's balance. You're aiming for a 1:2 risk to reward ratio on the trade. So you risked 1% on the trade you took, and then it ended up being a winning trade. And so now you're up 2% on the account. Let's say you took another trade and it was a losing trade, so you lost 1%. Every time you take a trade, you're risking 1% and aiming to make 2%. So your winning trades bring 2% in profit. Your losing trades take 1% of your account's capital in loss, okay? So let's say the next trade you took was also another winning trade, so you made 2%. Okay, the trade after that was a losing trade also. Then you took one trade, you made 2%. You took another one, you made another 2%. And then you had one loss after that, okay? Now, from here, which is the highest point your account, where your account reached, to this level, okay, this is going to be known as what is your drawdown. Okay, this is the normal drawdown, relative drawdown, or whatever you want to call it. Okay, there's what is known as absolute drawdown. Absolute drawdown is how much your trading account went below your starting balance. So let's say you are starting with $100,000, okay, and then the first trade you took was not a winning trade, but you immediately went into a loss of minus 1%. So your account is like $99,000 now instead of 100,000. This would mean your absolute drawdown is, minus $1,000, because you went from $100,000, which is your account starting balance, to $99,000 when you lost 1% on that trade. That's absolute drawdown. But then there's this relative maximal drawdown, which is the distance from your account's highest equity, or the point where your account reached highest to its lowest point, okay? And this is what most traders refer to as drawdown when you talk about drawdowns, okay? There's absolute drawdown, maximal drawdown, and relative drawdown. All in all, drawdown is just a way of saying your account encountered a loss or a couple of losses or whatever, and so your account moved from being at a high point to a certain low point. That's what drawdown is. Now, the thing is, whichever trading strategy you choose to use in Forex trading, okay, like I told you earlier on, no matter how good it is, you're not going to get winning trades 100% of the time. And the losses that you're going to encounter based on the trades that you take is what is referred to as drawdown. Okay? That's what is referred to as drawdown in trading. Okay? So usually you want to be very good with your risk management. If not, drawdowns, when they occur, if you don't have proper risk management, you could end up blowing your entire account. Just like I gave you an example. If you're risking 1% of your account's capital on each trade you take, and you encounter 10 losing trades in a row, okay, you're only going to be down 10%. That's not a problem, especially if you're trading with a risk to reward ratio of 1:2 or 1:3 or whatever the case might be, because even though you encounter 10 losing trades in a row, just half of those series of trades that you took, half of those losses, if you were to get, a winning streak that is just half of it, you'd recover all that you lost. And if you're even trading with a risk to reward ratio that's more than 1:2, you'd even make more. Let's say you took 10 losing trades in a row and you took 5 winning trades in a row. If you're risking 1:3, those 10 losing trades will only cause you a minus 10% loss. While those 5 winning trades will give you 5 times 3, because each winning trade brought in a profit of 3%, they'll give you a gross profit of 15%. So when you subtract your gross loss of minus 10% from your gross profit of plus 15%, you still end up with 5% profit. Okay? So the reason why this is important is because the moment you accept that losses are part and parcel of trading and that drawdowns are inevitable, and then you plan for their occurrences by using proper risk management with the right risk to reward, and having your mindset solid, so that even if you have 10 losing trades in a row, you're not going to abandon your trading strategy or start doubting it and not take trades and do all of those psychological trading errors. Then you are in a very good spot, because when drawdowns do occur, which is inevitable, you're going to be in a very good position to take care of them, to handle them well, like a professional trader. Okay? So, moving on. Don't think that just because you encounter losing trades or you encounter a drawdown, that your trading strategy is bad or you're a bad trader. Even the best in the business encounter losing trades. In fact, some of the traders that have made a name for themselves, that are considered legends in the industry, some of which include traders like Richard Dennis, among the turtle traders or whatever, the guy who taught those traders, the turtle traders, to actually get those outstanding performance. Okay, Richard Dennis. The type of trading style he uses is trend trading, and the win rate for his trading approach was mostly around between the 30 to 40% mark. But he made outstanding gains, outstanding performances with that little win rate, The reason being, his losses were only very, very small, and his profits, his winning trades made much more than his losing trades caused him to incur in losses. Okay? So, having that kind of mindset, you'd understand that, okay, even if I take a losing trade, it's not as if my strategy is bad. No, even the best trading strategies in the world are going to have losing trades. Okay, so you should know that, because the reason why I'm saying this is because most traders feel that, okay, because they are trading with a particular trading strategy, and so they got winning trades, they got losing trades, but there came a point in time where they had like 5 back-to-back losses. Now they're thinking their trading strategy is trash. Absolutely not, because in fact, that's why it's important to backtest, because when you backtest your trading strategy to see how it would have performed in the past, and let's say you do what the professionals recommend, which is at least taking like 100 trades with it, at least on a minimum. From those trades, you'd have numbers which would serve as benchmarks for you. So you'd see, over those 100 trades that I took in the past when I was backtesting this trading strategy, what was its maximum consecutive losses? So if when you took those backtesting trades, you notice that the strategy had 10 losing trades back to back at some point in time in the past, you can expect to have that type of performance in the future, or even double that. In fact, that's what professional traders tend to do. If your strategy from your backtest had a maximum consecutive loss in the worst period that you experienced in the past, which was like 10 losing trades, okay? Now, when you are trying to trade with that trading strategy in the future, plan for a even worse situation than that. Plan for having 20 losing trades in a row. Because when you do plan for that, even if you was to come and pass, eventually you would have set yourself up in such a way that you're not going to blow your trading account because you planned for that. Okay? It's very important to have this at the back of your mind. Because most traders will be like, you know what, I'll just take this trade and whatever the case might be. But then when they lose 1, 2, 3, 4, 5 trades in a row, they'll say something is broken with the trading strategy. And then when they tweak and change that trading strategy, something that it's not, then that one might now start giving trades which would have been winning trades, but they are not trading it again. They've dumped it and they're trading something completely different. And that's why being consistent with not only your risk, but your trading approach also, how you identify your entries, how you identify your exits, what you do, how much you risk, all of those things, being consistent and not changing them on the fly, or when you encounter a couple of wins or a couple of losses, is very important. Because if you're not consistent, your outcome will also not be consistent. Okay? It's also going to be very difficult for you to maintain a consistent outcome. When you're encountering a drawdown, it's very important that you remain consistent with your trading approach. Okay? Focus on executing your edge flawlessly and not deviating from it. Okay? So let's look at a couple of examples of trades, examples that you would have taken with a simple market structure trading strategy, okay? And how its outcome would have been, okay? So let's take a look at this. This is the daily time frame, okay? This is just a simple market structure trading example, for example, okay? So let's say you can see that this market has been in an uptrend. So it went from, let me pick this tool. It went from forming higher highs, higher lows, higher highs, and then this is a lower low, okay? So at this particular moment, this was a warning signal for us, okay? That this trend that looked very strong, this bullish trend, is likely beginning to weaken. The reason is because, as you can see, we had this higher high and this higher low, and then we had another higher high. If this trend was really a strong uptrend, price would have no business coming all the way down here, okay, to break below this low. Some would argue that this is a liquidity sweep, and it looks like that here too, because assuming this was a liquidity sweep, price just took out the stops for the traders who went long somewhere around here, and then it reached here. But then the reason why I find it a bit difficult to consider this just a simple liquidity sweep as opposed to being a sign of a reversal in the market, you can see that immediately after price broke above this resistance, it found it very, very difficult to continue moving up. And so eventually it formed this, again, it broke another higher low. Okay, and then after breaking this higher low, it couldn't even retest this resistance area. Okay, so let's assume that you're trading based on the trend. So you identified that price was in an uptrend, and then let's even say, you know, you're a trend trader, and after spotting this, you decided you were going to go long. So you took a long trade here, somewhere around here, because you're expecting price to, let me pick this tool, the long trading tool, at the close of this bullish engulfing candlestick, because you're expecting price to hold on to this. If it was really an uptrend, price should hold above this resistance area, and you're going for, let's say, 1:3. Okay, so with a 1:3 risk to reward ratio, this would mean you're risking around 430 pips on this trade. But since it's points, we're going to leave it at 4,003, and then 4,003 times 3, that would be something like let me just quickly do this. Let me quickly just raise it up here. Raise it up here to 1:3. Okay. Okay, you can see it's above 1:3 even. But then this was a losing trade. Now, the approach, I'm pretty sure you understand the approach. When price is in an uptrend, we're waiting for pullbacks to take trades in the direction of the trend. And that's exactly what we did here. So your approach, you've already mapped out your approach. But then, because however good the approach might have performed in the past, it's not going to call 100% winning trades forever. Then you can see that we had a losing trade here. Okay? Does this mean that the approach is flawed and it's never going to work again? Obviously not. This is because, like I keep telling you guys, losses are part and parcel of trading. If you don't even embrace losses as being part and parcel of trading, you're going to have a very, very hard time being a good trader. Okay? So let's say you took this trade and then it turned out to be a losing trade. Big deal. That's not a problem. Let's say, again, you even saw that, okay, price is, after taking you out, price made this higher high. Okay? Price took you out somewhere around here. But then it made this higher high because this high is now higher than this low. And so you were waiting for a pullback. But then when price formed this bullish engulfing candlestick, it didn't close above here. So you couldn't take the trade here. Okay? And so when this happened, you decided that, okay, it looks like price is struggling to break above resistance here. And so now you're doubting the strength of this long bullish trend. And eventually, when price formed this low, this higher low, and it broke above it, this was our first cue that, okay, the trend has reversed. And so since we are now forming lower lows and lower highs, when price did this and it confirmed to us that it's now forming lower lows and lower highs, guess what? When price did this retracement and it formed this bearish engulfing candlestick, this would have been a trade setup you would have taken somewhere around here, with your stop loss being above the higher low and aiming for a 1:3 as usual. Okay? And you can see this would have been a winning trade. Now, when you took that loss here, if you had folded your arms and said, okay, you know what, my market structure trading strategy seems to have a little bit of fault now, and so I'm going to take a break from the market, I'm just not going to trade it, you would have missed out on this trade setup. Okay? And this trade setup would have made, if you lost 1%, if you're risking 1% on the trades you take, and you lost 1% on this account, and you made a profit of 3% from this trade, this 3% would have easily paid for the minus 1% that you would have encountered here. Okay? And so, if you had ignored taking this trade because you now feel your trading strategy is not working, you'd still be down minus 1%. And this is why I told you that when you are in a drawdown, you need to forget about recovering what you lost. You just need to focus on the process. Okay? The process in this case, for this particular trading method, is identify the direction of the trend using market structure. So is price forming higher highs and higher lows? If that's what is happening, awesome. Look for long trade setups. As long as that trend, the direction of that trend is not invalidated. Again, if the structure that price is printing is a market structure for a downtrending market, forming lower lows and lower highs, again, do not change the rules of the strategy. Just execute it. Wait for price to make a retracement, take a low risk high probability trade setup, risk 1%, go for a 1:3 risk to reward ratio. And eventually, if you continue trading like this, even if you were to take like 5 trades, and then, 3 of those trades were losing trades and 2 of them were winning trades, with the 3 trades that were losing trades, if you were risking 1% of your account capital on each of those trades, you'd have only lost a gross loss of minus 3%. Because each losing trade would have cost you a loss of minus 1% times 3 losing trades. But then, those 2 winning trades, if you're aiming for a 1:3 risk to reward ratio, meaning you're risking 1 to make 3, those 2 winning trades would have brought in a gross profit of plus 6%. Now, when you subtract your gross loss of minus 3% from your gross profit of plus 6%, you'd still be up plus 3%, even though your win rate is like 40%. So, all this to say, most beginning traders and losing traders focus on the wrong things, in the sense that when you first get involved with trading and you don't know that losses are part and parcel of trading, you would be trying your absolute best to find the highest win rate trading strategy that will not lose, or that doesn't even matter. You could have a trading strategy that has a win rate up in the 90% or 80%, but if you don't practice proper risk management, or if your mindset is all over the place, you would still be a losing trader. And somebody out there with a good trading approach and good risk management and a good mindset risking like 1 to make 3 or 1 to make 4, or whatever the case might be, making having a consistent 1% risk per trade, and a trading strategy that has only a 40% win rate would crush your performance every day, every time. Okay, so drawdowns are part and parcel of trading. All this to say, drawdown is just a fancy way of saying trading losses. Okay, whichever trading approach you choose to use, you are going to encounter losses. Sometimes it might just be one winning trade, one losing trade, and a couple of whatever the sequence might be. And other times it might be, a couple of losing trades in a row or a couple of winning trades in a row. It doesn't matter. You just need to execute your edge flawlessly. Whether you are in a winning streak or a losing streak, it doesn't matter. Execute your edge flawlessly. Okay, that's all that matters. So all this to say, the way to manage drawdown effectively is to act as if you are not even in drawdown. What would you do if you were not in drawdown? You execute your edge flawlessly. So if your trading strategy says if you identify market structure, take trades in the direction of the trend, do that. Whether you're in drawdown or you're not in drawdown, do that. That's what you need to do. Just because you're in drawdown doesn't mean that you should now start, not taking trade setups based on what you've backtested. And again, another thing is backtesting is going to make it easier for you to actually adapt to what is realistic in the market. So if you don't backtest a trading strategy, there's no way you would know its benchmark stats. Like this was the average, losing trades it had, or the max consecutive losses, or the max consecutive. If you don't have all those numbers, everything that happens in the market in real time is going to hit you off guard. But if let's say you've backtested this trading strategy for the past 3 or 4 years of data, historical data, and you've seen that, okay, having 10 losing trades in a row or 5 losing trades in a row is normal. When you experience that in real time, in real life market conditions, it's not going to, throw you off guard all that much, because you are already expecting that to happen because you've seen it happen. Okay? So this pretty much brings us to the end of this week's edition of the ITU Forex class. But before we wrap up, I'd like to again let you guys know that this is the part of the company where we teach you guys how to actually become consistently profitable traders using simple trading techniques with proper risk management and the right mindset and all of that. But we also have tools and bots, expert advisors, which are designed to help you trade on your behalf. Okay, and do the proper risk management, identify low risk, high probability trading opportunities for you, following our step-by-step guide and step-by-step instructions. So if you want to start earning while you're learning how to trade, if you're interested in that, please reach out to us on the socials or drop a comment in the comment section, and we'll be more than happy to assist you, walk through everything, the setups and all of that. Okay. Once again, thank you for taking time out of your busy schedule to attend these classes. I really appreciate it, and God bless you. I look forward to seeing you guys in next week's edition. Have a wonderful rest of your week. Go out there and practice what you've learned today, okay? All of these things we're teaching you guys, practice them, internalize them, and then see that it works for yourself, okay? Because I might be here telling you that this is how to do it, but if you don't actually take the time to practice them and internalize them, it's all going to be a waste of time, okay? So once again, thank you very much. I look forward to seeing you guys in next week's edition. And don't forget, if you're interested in any of the bots, please reach out to us on the socials, and we'll be more than happy to assist you set everything up in a step-by-step manner following our tutorials, okay? Thank you, and God bless you. Enjoy the rest of your evening. Cheers.